Welcome to the Deep Dive. Our mission today is to really cut through the noise surrounding Penguin Solutions, Inc., that's PENG, after their Q4 and full year 2025 earnings call. This wasn't just, another quarterly report. This felt different, like a company announcing a full strategic shift right into the heart of enterprise AI.
Exactly. Yeah, for you, the listener, this call was absolutely pivotal. PENG is trying to move away from being, a sort of legacy holding company. They want to be a focused, pure-play enterprise AI infrastructure provider, designing, building, deploying, managing, the whole stack.
And the tricky part is they actually executed pretty well financially in the past year.
Sure.
Showed real discipline.
They did. Impressive discipline. But the guidance they gave for the next year, it just terrified the market. So you have this huge divergence, right? Strong past performance, but real anxiety about the future. It couldn't be clearer.
Okay, let's start with that past performance then. Let's look at Q4 fiscal 25 first. Profitability-wise, seemed okay. Non-GAAP EPS hit $0.43. That beat the consensus of 37 cents.
Right. Comfortably beat it. Sounds good on the surface.
But the revenue, $337.9 million. That actually missed what the street was expecting, which was closer to $342.1 million. Still up 9% year over year, but a miss is a miss.
And that small miss, that was maybe the first little red flag, even though, the full fiscal year 2025 was fundamentally quite strong. Total net sales hit $1.37 billion. That's up 17% year over year. And critically, non-GAAP diluted EPS surged 53% to $1.90.
53% EPS growth. Wow.
Yeah. Massive profitability jump. And that was really down to smart operations. They managed costs tightly. It was actually their fifth straight quarter of year-over-year non-GAAP operating margin expansion. So you got to give them credit for managing what they could control.
Okay, so paint a picture here. An efficiently run company, at least looking backward.
Mm-hmm.
Now, let's pivot to the forward view. The big story management is pushing is this transformation, moving beyond just selling boxes to designing, building, deploying, and managing these complex AI systems for enterprises. What's the core idea there?
Well, the core belief, I think, is that the real margin, the sustainable profit, isn't just in the hardware, the metal. It's in the managed services, the software, the ongoing relationship. They're chasing that sticky, recurring revenue you get from these high-touch, often custom infrastructure deals. And when you look at their different business segments, you can kind of see this shift playing out, especially in advanced computing.
Right, advanced computing. Q4 sales were $138.3 million. But the number that really jumped out, for me anyway, wasn't the total revenue. It was the fact that their HPC and AI revenue, specifically from non-hyperscaler customers, grew, get this, 75% year over year in FY25.
At 75%, yeah. That's the key proof point, isn't it? It validates their diversification strategy, moving beyond relying solely on those huge, sometimes unpredictable hyperscaler deals.
Seems like it's working then.
And management highlighted a couple of really good examples.
Right.
First, that win with a Tier 1 U.S. financial institution, their first on-prem gen AI data center build-out. That's a complex, high-value contract.
Definitely a flagship win.
And second, successfully finishing that big HAN GPU as a service system for SK Telecom and the Korea Ministry of Science.
Hold on a sec. And a GPU as a service. Can you break that down a bit for the listener? What does that actually mean in practice?
Sure. So Anna usually makes you think of SAP's in-memory database platform, right? High-performance analytic appliance. When Paying gets a contract like HANA GPU as a service, it basically means they're designing, installing, and then managing a really powerful customized cluster of GPUs, specifically tailored to run super fast, intensive analytics and AI jobs for a huge client like SK Telecom.
Okay, so it's a bespoke, managed, high-performance system.
Exactly. And the fact that PN delivered that system, their first big international deployment like that, in just 2 months, that shows some serious deployment speed. Impressive stuff.
Okay, yeah, that context helps. Now let's jump to integrated memory. That bred in $132.2 million in Q4, and for the full year, it grew 30%. Their angle here isn't just competing on bulk memory prices, right? It's more specialized.
Precisely. They're selling the value add. Custom designs, specialized firmware, guarantees of extreme reliability that you need in these high-performance computing environments. It's not commodity DRAM. This segment is really positioned as their engine for future differentiation. They specifically talked up their work on next-gen tech, like CXL products, Compute Express Link.
CXL?
Yeah.
Sounds technical. Why should, the average listener care about CXL? What's the big deal?
Good question. Because it tackles one of the biggest headaches in modern AI computing, memory access. Right now, GPUs, CPUs, they often have their own separate siloed memory. CXL is basically a super fast connection that lets all these processors pool and share memory resources across the whole server rack much more efficiently.
Okay, so like turning lots of small hard drives into one giant, faster network drive.
That's a pretty good analogy, yeah. For P&G, it means they can offer systems with much lower latency, much better resource use. That justifies their premium pricing. It cements them as an infrastructure innovator, not just a reseller. They also mentioned a longer-term play, the optical memory appliance, OMA. But that's further out, targeting late calendar 26, early 27 for first shipments.
Got it.
Yeah.
So integrated memory is definitely playing in that premium specialized hardware space. And then the smallest segment, optimized LED, $67.4 million in Q4. Revenue was kind of flat.
Revenue is flat, yeah, but they actually improved the non-GAAP operating margin there by 250 basis points.
Really? How?
Just efficiency. It shows that even in a tougher market segment, management was still finding ways to optimize. So overall, the full year picture was solid. $113 million in operating cash flow, up 8% year over year. Plus, they announced a new $75 million share repurchase program. Everything looked pretty good until they got to the guidance.
Right. And here's where it all seems to unravel for the market, because despite that solid financial history, the strategic progress, the stock just tanked, dropped 16% in one day. And it seems entirely based on the FY26 guidance. Management guided full-year net sales growth to 6%, plus or minus 10%, that midpoint. It's way below the 10% growth the street was looking for.
Yeah, that 6% midpoint, that's what hit the panic button. Now, management quickly tried to explain it. They said, look, this seemingly weak number includes a huge quantifiable headwind, a 14 percentage point negative impact on total company sales growth from two specific deliberate actions.
Okay, what were those actions?
First, winding down their higher margin Penguin Edge business. Apparently, two big customers aren't renewing contracts for an older product.
Okay, end of life stuff happens. What was the second?
The second one is the real shocker. They are assuming zero hardware sales to hyperscale customers in FY26.
Zero, as in none.
Zero hardware sales. Now, they'll still get services revenue from those big guys, but those large, reliable, even if lower margin hardware shipments they had in FY25, gone. Wiped from the forecast. They're basically saying they just don't have visibility into that business right now.
Okay, let me push back on that a little. That hyperscale hardware revenue, maybe it was lower margin, but it was predictable, right? Reliable volume. Zeroing it out. That feels like either a massive risk they're acknowledging, or maybe are they just trying to set an incredibly low bar to make the underlying growth look better?
That is exactly the debate happening in the market right now. Management's story is, we're cleaning house, focusing only on the high-touch, high-margin, sticky enterprise clients. And if you do strip out those 14 percentage points of specific headwinds, the edge wind down, the zero hyperscaler hardware, then the implied underlying growth rate for the remaining core AI business, it's roughly 20%.
Okay, so the narrative is, P&G is intentionally ditching 14 points of reliable lower-margin sales to chase 20 points of complex, high-margin future sales. So why isn't the market cheering a 20% growth story?
Because of the execution risk. And that risk is all tied up in how back-end loaded this guidance is. This is the absolute core of why the stock dropped 16%. Management is projecting only 46% of sales will happen in the first half of FY26. The majority, 54%, is expected in the second half.
46% in H1. How does that compare to last year?
Big difference. In FY25, it was 52% in H1, mostly driven by those predictable hyperscaler shipments they're now zeroing out.
So that's a fundamental change in how the business flows through the year. Why the big shift?
Because they're now fully embracing the enterprise sales cycle. And that cycle is just, it's slower, it's lumpy. It depends on big company budget decisions. These new AI compute opportunities, they're chasing those big custom clusters for banks. For example, management says the pipeline is strong, but they haven't actually converted to sign deals to bookings yet.
So they're shifting from selling fairly standard stuff to selling like complex blueprints and construction projects for AI factories.
That's a good way to put it. And that uncertainty means they need a wider guidance range, that plus or minus 10%, to cover the different potential outcomes. They are making a huge bet that the pipeline converts strongly in Q3 and Q4.
And that timing risk doesn't just hit revenue, it hits profits too, right? The non-GAAP gross margin is expected to compress down to 29.5%, plus or minus 100 basis points from 31% in FY25.
Right, but that margin compression is actually sort of predictable within the strategy. Think about it like building that custom kitchen you mentioned earlier. P&G lands a big new AI client. First, they sell the hardware, the GPUs, servers, racks. That's the initial setup. That part has the lowest margin. The real profit comes later from a high margin recurring stuff. Software licenses, ongoing management fees, professional services. So we're seeing the margin squeeze from the upfront investment phase, not necessarily a sign of weak pricing power.
Okay, so near-term pain for potential long-term strategic gain. But that's cold comfort to a nervous market, especially when the outlook for advanced computing itself ranges from minus 15% to plus 15% year-over-year growth. That range just screams uncertainty.
It absolutely does. That range perfectly captures the timing and conversion risks. The market is basically pricing in all that near-term uncertainty rather than giving credit for the long-term transformation story management is telling. The risk is simple. If that pipeline stalls, if those big enterprise deals don't land in H2 as expected, then the first half results are going to look really, really weak, potentially a huge guidance miss.
So even though AI infrastructure demand generally is strong, P&G is caught in the specific choppiness of these large custom enterprise deals. Still, a 16% stock drop feels pretty extreme just for a timing issue, doesn't it?
It does feel extreme. The market hates uncertainty more than almost anything. Investors need concrete proof points now. They need catalysts to feel comfortable about that H2 ramp. We'll need to see, specific booking announcements, news of major AI cluster wins, evidence that these deployments are actually happening, something to justify belief in that underlying 20% growth story. Right now, the stock price reflects an assumption of the worst-case H1 scenario.
Okay, now for our segment where we put on our sharp fund analyst hat and pitch an outrageous but plausible trade idea based purely on this deep dive. And the usual reminder, this is strictly for education and entertainment, absolutely not financial advice.
All right, so given that 16% cliff dive, the price is clearly reflecting maximum fear about H1 visibility and this execution risk. That panic creates a situation where volatility is really high. Our take is the market is probably over-discounting the likelihood of converting that underlying 20% core growth. The timing risk feels temporary, whereas the strategic shift towards AI infrastructure feels more permanent.
Okay, makes sense. So what's the play?
It's a structured volatility play. Because volatility is so high right now, especially on near-term options, the premiums are juicy. So the idea is sell short-term, out-of-the-money put options, maybe 30-day expiry. You collect that inflated premium, basically betting the initial panic finds a floor pretty soon. Then you take that premium cash you just collected and you use it to buy long-dated, deep-in-the-money call options, say 12 months out.
Using the market's fear to fund a long bet.
Exactly. You're essentially funding a long position on the eventual H2 recovery and that fundamental 20% underlying growth story, using the premium generated by the current fear. It's a bet that the timing risk blows over, but the strategic growth sticks.
A sophisticated way to play for a confidence rebound by Q3 or Q4. And let me just say it again, purely for entertainment and educational purposes.
Sure.
Please talk to a certified pro before doing anything like this.
Absolutely. So the big takeaway here is that P&G nailed FY25 profitability, really executed well, but they've presented this challenging, very back-end loaded FY26 outlook. It puts all the pressure on management to execute flawlessly. The whole story now is about timing, risk, and converting those big deals in the very dynamic enterprise AI space.
It really is. And that brings up a really interesting question for you, the listener, to think about as you watch this space. Given that management did successfully grow that non-hyperscaler business by 75% last year, how much of the market's current deep skepticism is really justified by the known difficulties of these lumpy, complex AI projects? And how much is maybe just broader macro anxiety creeping in, worries about overall capital spending slowing down everywhere?
Yeah, figuring out that distinction, that's often what separates a long-term investor from someone selling in a panic.
A fantastic thought to chew on. Thank you for joining us for this deep dive into Penguin Solutions' very complex earnings narrative. We'll catch you next time.